Hello, I'm Beryl Nassasan, and this is Pink Diamond, the show that digs deep into the pink sheet markets to find diamonds in the rough. With coronavirus dominating headlines, another huge story was relegated to the sidelines: the dispute over oil between Saudi Arabia and Russia. While COVID-19 will have a lasting impact on the global economy, the sudden oil price drop played a huge role in the collapse of global equities at the start of March. However, now that headlines are suggesting a truce has been made, today's company is in a good position to prosper. Scorpio Tankers engages in the seaborne transportation of refined petroleum products in shipping markets worldwide. As of March 27, 2020, it owned financed, leased, or bareboat chartered 137 product tankers, which had an average age of just under 4.5 years. The Monaco-based firm was founded in 2009 with a representative office in New York and has a market cap of just under $1 billion. Last year, it had annual revenue of $704 million, but made a $49 million loss. Looking at the technicals, we see that Scorpio has a return on assets of minus 0.94%, which is in line with the rest of the industry. The firm's Piotrowski F score of 6 suggests that it has an average health and profitability ranking. The price-to-earnings ratio is negative for Scorpio, as in the last year, negative earnings were reported. And with a forward price-to-earnings ratio of 4.41, the company can be described as cheap. Furthermore, the low PEG ratio, which compensates the price-to-earnings for growth, indicates a rather cheap valuation. Scorpio's earnings per share has grown by an impressive 79.39% over the past year and is expected to grow by 252.81% on average over the next 2 years, which is extremely exciting for potential investors, especially when comparing to the rate of the past 5 years. Growth is accelerating. Looking at last year, Scorpio is showing very strong growth in revenue, which increased by 20.39%. The average revenue growth over the past 5 years has been 15.49% per year, which is good. The firm has a debt-to-equity ratio of 0.51 and is one of the better performing companies in a sector, outperforming 85% of its industry peers. However, weak, quick, and current ratios suggest that the company may have issues paying short-term obligations. Looking to the charts, there is an obvious correlation with the price of oil, with the stock sold off in early January, posting an all-time low in mid-March at just $12.35. However, investors will take comfort from the relative stability of the stock, bouncing off that low and finding support at levels last seen in 2018. Momentum is range-bound, and the 50-day moving average is providing resistance to attempts to push higher. It's possible that the price could come down to confirm the $12.35 low again. And if that level holds, a close above the 50-day moving average will be viewed as a sign of momentum change. As always, please make sure to do your own due diligence before making any investment decisions. Stay safe and see you next week.